So I am Nicholas Maddox. I am the new Director of Plan Giving here. So my official title is Nicholas Maddox, also known as Sandy Vandenberg. Everyone loves Sandy. I love Sandy. I've met her several times. She's a wonderful person. She continues to come around, and we truly miss her. She's part of your family. I'm trying to get her to let me be part of her family because she's truly been great and gracious to this organization. So as the organization, we'll definitely miss her. I hope that you guys will take me on and enjoy me and love me just as much as you guys love Sandy, okay? Please? Yes? Okay, thank you. Thank you. So again, thank you guys, thank everyone for coming. I want to welcome you guys to the Taking Care of Your Financial Health seminar that has been made possible by the Torrance Memorial Foundation and its Professional Advisory Council. You'll see several members of our Professional Advisory Council around. They are professionals in the area that I lean on to help me with expertise in certain areas. There are our subject matter experts in areas of law, accountancy, taxes, fiduciaries, estate planning. So as I rely on them, I hope that you guys will rely on them as well. The mission statement of the PAC is the Professional Advisory Council is a volunteer group of estate planning attorneys, accountants, financial planners, fiduciaries, and elder care professionals dedicated to supporting Torrance Memorial and educating the community on the benefits of charitable tax and estate planning. Okay, so I kind of just stole my own thunder there, reading the mission statement. So in the case of housekeeping, if I could ask everyone to please silence your phones out of respect for our presenters that we have today. Restrooms are located out the door to my right, your left, and to the right. And at the end, so that everyone stays through our presentation. I hope everyone got a raffle ticket. Did everyone receive a raffle ticket? Or I should ask, did anyone not receive a raffle ticket? Please raise your hand. Right here, do we need a raffle ticket up front? Do you need one? Okay, perfect, okay. And we need one over here. Okay, so one raffle ticket over here, please. So everyone or every couple, I hope, has received a copy of today's presentation. Today's presentation is also being recorded via Zoom, so I will be able to send out the presentation. So if you miss anything, or if we aren't able to catch that note, don't worry. We will resend the presentation out via Zoom, and you can rewatch it as many times as you like, okay? There are index cards in front of, on each table. If you have any questions throughout, please write down your question. We'll collect them at the end. And at the end of the presentation, I will come around or we'll present them to our presenters to answer the questions. Unfortunately, we probably do not have enough time to get to all of them, but we will try and address as many of them as we can. And if we have to get back to you via email or any other way, we will do that as well for you, okay? Understand that they may not be able to answer every single question, but we will do what we can to get to all of them. Those that are on Zoom, watching via Zoom, if you have any questions, please place them in the chat. And I am monitoring the chat, and we will, at the same time, just like the people here in the room, we will try and get to those questions just the same, okay? Any questions before we get started? All righty. So real quick, just as a form of update, as everyone knows here, we are extremely busy hospital and extremely busy emergency department. And because of that, we have taken on the task of raising $60 million in order to expand our emergency department. When we hit our goal and when we're really, really close, but we don't mind going over because if everyone knows, whenever you do a construction project, you probably usually go over your budget, right? And once done a home renovation, you usually go over your budget. So we're very close, but we don't mind. If you have any extra dollars you want to send to our emergency department expansion fund, please do so, okay? But we will have the only two-story emergency department in the state of California once our project is completed. It's going to be a fantastic project. We are currently seeing a little over 111,000 patients through our emergency department. And if anyone's ever been to our emergency department, can you imagine seeing 111,000 people throughout 1 year? That's what we're doing right now. So it is dire that we expand it so we're better able to take care of our community. So we're almost there. But again, if you have any other donation you'd love to get to that, we would appreciate that. Secondly, who here has been to our holiday festival? Yeah? Everyone's been around? That's a good amount. Okay, our holiday festival is a week-long celebration here on the property of the hospital. Right in this corner over here, we put up a 100 by 300 foot tent, and we enjoy the holidays. We have live events, we have performances, we have a big party at the end of the week. And we have, it's just a great time for the community to come together. Through that process, however, it is a fundraising activity as well. Through that process, through our holiday festival this year, we raised over $2 million going towards the expansion of our emergency department. So we had a fantastic holiday festival. It was extremely successful. It was my first year. It was a lot of work. It was a lot of fun. Anyone who's ever been there knows there's a lot going on, but it is a great event for the community. So this year's holiday festival was extremely successful, and that couldn't be done without the support of our community. So individuals like you and our community, is because of you that it is so wildly successful. All right, so I'm going to try and keep this short. Okay. Again, I am the plan giving officer here. That is my main function. I know we have presenters here that have a ton of information for you, so I'm going to go through my information as quickly as possible for you, just so that you don't get tired of me, because I want you guys to love me again, like Sandy. So I don't want you guys to get bored of me already, okay? So there are 6 main types of plan gifts, all right? We have our bequest, which is essentially giving your gift through your will or your trust, or designating us as a beneficiary on an account, okay? So simply, if you have an extra bank account, your bank that you don't use, you could list Torrance Memorial Foundation as your beneficiary, and upon your demise, we will become the recipients of those funds. Very, very simple. That's probably the simplest gift, the simplest way to make a gift to us. Okay, the next, I'm gonna couple these together. It's the immediate charitable gift annuity and the deferred gift annuity. I'm gonna skip over those, I'm gonna go over those in a second, okay? And then we have our charitable remainder trust, our retained life estate, and our IRA beneficiary, okay? So anyone, again, who has an IRA that you're not using, I remember in my former life, I used to be a financial advisor, so I'd have a lot of my clients that didn't even use their IRAs. They just had to take that distribution. They didn't need it, so we would take it at Christmas time, and they would use it for gifts for their grandkids. Mitchell, got it? Okay, Mitchell's on it. Thank you. So excuse a little technical difficulty. We'll get through it. Let's see. There we go, okay? So last one. So I want to just quickly highlight a charitable gift annuity. Who here is familiar with annuities in the room? I need to raise your hand higher, a little higher. Who's here? Okay, so most of us are familiar with annuities. Did you know that you could have an annuity with a charitable organization? So just like when you go to your bank or your financial advisor, you get an annuity, you could also get an annuity here with Torrance Memorial. So I'm going to go through just one of the options here, okay? I'm going through our first donor, age 75. And so just like when you get your annuity at your bank, we have a rate. I think it's a pretty decent rate. For most of my financial advising career, the rates were like 2%, 3%. So at a 5% annuity, we're getting pretty good money. And the benefit of this charitable gift annuity is that at the end of the term, you are able to receive income on an annual basis. And at the end of that term, at the end of your lifetime, the remainder of the funds go to your organization. So sometimes in the event where you may not have enough money to maybe make a large donation, but you want to be able to still be able to live off your money, here's a way that you could collect interest off of your funds and at the same time make a gift to our organization at the end of your lifetime. And so this is one way where we can get good rates. I know a lot of us that, I won't say a lot of us because I was born, but I didn't live through the 80s. A lot of us remember the double-digit interest rates. But these are still nominally very, very great for our donors. And so this is one way that we're able to give back to organization and still be able to live off of your money, okay? We can definitely go through more details of this if anyone has any more questions, but I want to be very, very short and brief so that our presenters who have actual good information, real information, they can go through the information with you, okay? So you're done with me for the time being. I will come back at the end. And I want to right now introduce to you our president of our co-chair of our PAC, Betty Bergman.
Good morning, everyone. Oh, that's what I'd like to hear. Okay, so we're here for individual taxation and wrapping up 2024 and planning for 2025. So to get started, I want to ask my speakers to come up. So I will introduce them. And then I would also like to have all the members of the Professional Advisory Council for Torrance Memorial, who helps put these seminars on, who is volunteering this morning, to come up to the front so I can introduce and thank them. So Karen, Tom, Yvonne, everybody come up to the front so everyone can see who you are and we can introduce you. Okay, you guys can come up here. Okay, these are the members of our Torrance, the Professional Advisory Council for Torrance Memorial. We've got Tom and Karen and Yvonne, Angela. Who else is here? Larry, Claire. So thank you, everybody. You probably met them when you came in and greeted you, and they're helping today. Thank you, guys. All right, so now I would like to announce or introduce our speakers for today. But for the seminar, I do want to also let you know a little disclosure here. So this is an informational seminar. The material is for general information only. It is not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please consult qualified professionals. And if you'd like to consult the speakers today, you can get at least Carol's card in the back. I think Brandon didn't have cards, but you can rush him at the end and get his information. Okay, so I am going to introduce the speakers. First, I'm going to start with Carol Kulencavich. Okay, these are both CPAs. Carol has over 25 years of experience in public accounting and has worked with privately held companies and their owners in a variety of industries. Part of Carol's focus is working as a team with her clients and their business advisors to develop integrated, cohesive plans for the most cost-effective approach to achieving the client's short and long-term goals. She also works with family groups, which may include multi-tiered consolidated entities, as well as multiple generations. Carol's specialization includes comprehensive tax planning and compliance with individuals and their closely held entities, multi-state taxation issues, and succession and estate planning. And Carol grew up in Hawaii, and in her spare time, she loves to go stand-up paddling in Redondo Beach and has paddled with dolphins and whales out there. Okay, and the other speaker is Brandon Hohm, full name Joseph Brandon Hohm. He's also a CPA at Medical Accounting Service, Inc. His firm focuses on personalized accounting for individuals, small businesses, and estates with a particular emphasis on medical and dental professionals. He has been a member of Torrance Memorial's YPPA, and YPPA stands for Young Physicians and Professionals Alliance, and PAC, the Professional Advisory Council, for several years and hopes to serve the hospital for many more years to come. He lives in Hermosa Beach with his wife and 2 kids and dog. And he once lived in Okinawa for 3 years. And unfortunately, now he has very high standards for sushi and sake as a result. So please welcome our speakers, and I'm going to hand it over to them.
Good morning, everyone. Good morning. All right, so for those of you who have been here in the past, we always start with our New Year's resolutions. And we'll read these together because they are important. They're a little humorous, but they also have a meaning. I will pay attention to mail that refers to important tax information and deal with any notices immediately. A lot of people get the letter in the mail, they put it aside, they're like, oh, I'll just give it to my accountant the next time I see them. By that time, the deadline has passed to respond to it. So as soon as you get something like that, absolutely call your accountant or someone who can help you decipher what this really means. I will keep good records. As CPAs, we want good records. So if you need help trying to put together good records, again, reach out to someone. This one is really important, especially these days. I will not believe everything on the internet, including ChatGPT, right? We know where this is all going, and there's just so much information out on the web, and it's really important to try to discern or have people help you discern what's really true and what's not. I will listen cautiously to my friends and family. I'm sure Brandon and I and many of you talk to people, and it's like, well, my friend said they could write off their dog, or my friend said they could, take some sort of deduction, and it's like, just don't listen to people or listen cautiously to people. I will not open mails or attachments or answer phone calls and provide information if I'm not 100% certain who it is. This is really important. Again, this is happening a lot where people are just making, I'm sure you've all experienced it, random calls from people or emails, and it sounds legitimate, or they say that they're from some organization that you're familiar with, but they're asking for either like your social security number or address or any type of personal information. So be very cautious of that. I've had clients who've answered those calls, and it's just a nightmare to try to unwind something like that. And the same goes with texts and links. Again, they know that people now are onto the email, so now you're getting those types of texts. Even with, unfortunately with the disaster that's happening with the fires, you're going to get a lot of charities reaching out, and even there's a lot of fake charities out there too, trying to solicit people to donate money. So just be extremely cautious. And I will ask for help when needed. Never be afraid to ask for help from people. These are just a couple of slides. I'm not going to really go through them, but we're part of the organization of AICPA, which is a national organization of CPAs. And they just came up with a couple of these stats, kind of the year in review. I just thought it was informational for people to kind of review and see, where we were and how the year looked. All right, so this is our agenda for today. We're going to go over some recent tax considerations, tax tables, estate and gifts, all of this stuff. So there's a lot of information, so hang on and we'll try to get through all of it. All right, key recent individual tax considerations. 2023 was the year where there were a lot of energy credits available for people that bought electric cars, that did solar improvements, that made improvements to their home. So not too much of that has changed because a lot of that did start in 2023. Excess business losses now effective through 2028, and this is for when you are limited on your business losses. Age for retirement minimum distributions for 2024 is 73. So if you turn 73 in 2024, you do need to start taking your minimum distributions from your retirement accounts. Form 1099-K changes, we'll go through that a little bit. Starting in 2024, there's a new provision that allows funds from college plans to be rolled over into Roth IRAs. So some people have savings in their 529 plans, and they haven't used it, and now they can roll it over into their Roth IRAs. So, we wrote this about 3 days ago, and we said otherwise not much has changed. As many of you may have heard already, there has been some changes effective yesterday with regard to filing dates, which Brandon will talk about, due to the disaster fires and the IRS declaring that we have an extension now of when we can file and pay our taxes. But Brandon will talk about that a little later. All right, so we're going to go through a couple of examples of how the tax rates work. In 2024, the highest rate is still 37%, whether you're single or married filing jointly. And for the high income folks, 37% is still their marginal taxable rate. So once you hit the highest bracket, then every additional dollar is taxed at 37%. And we say think of it as a layered cake because we'll go through the example, but it's like a layer. The first layer is taxed at a certain rate, the next layer is taxed at a different rate, and on and on. So these are the tax tables for 2024 and 2025. And what you can see, and this is, I know you've all heard about the marriage penalty. So the marriage penalty hits you at 37% because a single person is taxed at 37% when your income gets over $609,000. For married filing jointly, it hits you at $731,000. So not double of the $609,000 like you see in the other brackets. All right, so just a quick example. We have a married couple with wages, interest, rental income, so total income of $175,000. They don't have any itemized deduction, so they take the standard deduction of $29,900. So their taxable income is $145,000. So the first layer, and this kind of refers back to the tables, is taxed at 10%. The next layer is taxed at 12%. And then the final layer, up to the $145,600, is taxed at 22%. So their total tax is $22,000, not all at 22%. And you get the standard deduction, so it's not $175,000, but it's $145,600. So again, it's a layer of your different tax rates. Married filing jointly. And California works the same way. The highest bracket is 12.3%. And the same thing, it's taxed at different layers. We don't have the 2025 California tax rates out yet, but we have the 2024 rates. So as you can see, the highest bracket is the 12.3%. Again, for married filing joint, if your income is over $1,442,000. So here you don't have the marriage penalty. It's also important to note that there is an additional 1% surtax if your income is over $1 million. So I do tell my clients that are in the highest bracket that your rate really is 13.3%. AMT, so I'm sure you all heard the term. I'm not going to talk about it too much because with the current law, it doesn't affect as many clients as it did prior to 2018. But alternative minimum tax is basically an additional tax that is calculated in conjunction with your regular tax. But it is a different tax. It's an add-on where certain deductions are not allowed when you're calculating alternative minimum tax. So it's a kind of a convoluted calculation, but I'm sure you've all heard the term. But with the changes in the tax law from 2018, a lot of people were no longer affected by alternative minimum tax. Federal estate, gift, and GST taxes, just briefly, for 2025, the lifetime exemption is $13.99 million, meaning that you can pass away in 2025 with close to $14 million of net worth, and your estate won't pay any estate taxes. And that's obviously double if you're married. Extremely high for most people. That is set to expire at the end of 2025, but it's kind of a wait and see now. The annual tax-free gift is $19,000 for 2025. For 2024, it's $18,000. So what that means is that you can gift any person $18,000 or $19,000 for 2025 and not have to file any gift tax returns or pay any taxes. So this is really important if you're gifting to your kids or your grandkids to keep track of that, because once you go over the $18,000 or $19,000, it doesn't mean that it's taxable, but you do have to file a gift tax return, which is informational only. So, just make sure you keep track. So, it's gifts for birthdays or, special occasions, or if you gift them, I don't know, a car or stock or what have you, you do want to keep track of that. So as I mentioned, at the end of 2025, the estate and gifts tax exemption will sunset. So it's supposed to currently refer back to $5 million, but again, it's a wait and see. I should have started by saying that we call it the TCJA, which is the Tax Cut and Jobs Act. A lot of those provisions from that act is set to expire or sunset at the end of 2025, and we just have to wait to see what the new administration will be doing with regard to extending those. And we'll touch on that a little bit. Trump has said that he's going to extend or make permanent a lot of those provisions, but again, a wait and see. It's important, and I know we have future seminars on this, but with regard to estate planning, it's very important to do that with your attorney, because even if you have a very simple life with just a few assets, it's really important to do some estate planning, for getting the right documents, avoiding probate, protecting your assets, and making sure your health directives are all in line. And if you did it 20 years ago, it's time to look at it again. All right, income. So bottom line is that any income that you receive more than likely may be taxable. Gifts are not taxable, but everything else that you receive is usually taxable. And just because you didn't receive a form for it doesn't mean, in theory, that you're not supposed to report it. So you're supposed to be reporting all of your income. You get your W-2s, you get your 1099s, rent and royalties, anything that you receive is taxable. Gambling winnings are also taxable, and you normally will receive a W-2G for that. And people say, well, of course I lost more money than I won, and that's fine, but the deductions, you have to report the gross amount, the earnings, and then you report the losses separately, and you can only take the losses if you itemize your deductions. So unfortunately, that does affect some people where they have to report the earnings, but they don't get to offset it with the losses. $1099K, so this is a form that's been in existence, but they keep changing the rules on this. And basically, this is for third parties like Venmo, PayPal, where they have to now give you a 1099 for monies that they collected on your behalf, if it related to earnings. So for example, I just had a client say, I want to start using Venmo to collect rent from my tenant. And I said, that's fine. You are going to get a 1099K for that, meaning that now instead of, now she's going to have a form that reports the rent income that she received from her tenant. So it's important to know this, because sometimes there may be an instance where someone will receive the 1099K and also receive a regular 1099, and they double it up. So just be aware that the 1099K is a fairly new form, but it's been a bit confusing. It's also important to keep track of money that you receive through PayPal and Venmo, because if you get a 1099K and it's not really income, you still have to report it, but there's a space on the tax return where you can say, hey, this wasn't really income, and you can offset it with an adjustment. Brandon?
This is an income court case, Moore versus the U.S., which went up to the Supreme Court. So we throw in a few court cases into this presentation to kind of illustrate what's going on. And this is how we actually understand the tax code, is when judges deeply look into issues and okay, this complies or this doesn't. But the Moores took the U.S. to court saying, we got this K-1. We're not in control of the corporation. We never got a distribution, but they're claiming that we realized income. We don't feel that's right. And the Supreme Court looked at this pretty deeply, and they basically said, you know what? We're not going to go into the whole 16th Amendment issue, which would have just completely upended the tax code and the legal structure. We're just going to focus on if Congress can tax a shareholder at the entity level, and it can, that's all they said. But this, if the Supreme Court would have come back and said, you know what, you're right, you're a passive investor, if you don't get a distribution or something related to that income, then technically you can't realize it. That would have totally changed everything that we know about the tax code for realizing income. And it would have gone into the things where you're hearing about the wealth tax, being taxed on your wealth and other areas of the tax code. So this alleviated a lot of tax practitioners out there and legal experts, because we just didn't know what was going to happen with this court case. But this basically just said we're going to go status quo as it was.
Okay, so what can we exclude from income? As I mentioned, gifts and inheritances. So, people get confused. So if you give a gift, obviously it's not and I'm not talking about to charitable organizations, but if you give a gift to a child or a grandchild, it's not deductible by you, and it's also not income to that recipient. So I still get a lot of calls from clients. It's like, well, are they going to have to pick it up as income? I'm like, no, if it's a true gift, it's not taxable to them. Life insurance premiums, disaster relief payments, which is really important right now, 14 days or less on rental income. So that's a little quirky one. I've had clients when I used to work more on the west side that would have their houses rented, by some movie studio or something, for like 10 days, and they would get payment for it. Well, they didn't have to report that payment as income because it was only rented out for less than 14 days. Tax-free municipal bonds are not taxable. For California, you have to be a little bit careful to see what the California effect is. Most public welfare benefits, physical injury legal settlements, or wrongful incarceration settlements, those are not taxable. And alimony. Alimony is not taxable if it's executed after 2019, which also means that the person paying out the alimony cannot deduct it either. California doesn't conform, though, so it does get a little bit confusing. So for California, you do have to report it as income.
No, it's just.
Okay, skipping over this. All right, Social Security and retirement income. Okay, retirement minimum distributions, as many of you know, it's a yearly calculation. Currently for 2024, you have to take it if you're 73 or older. By 2033, the retirement age for the minimum distribution rises to 75. They're not required for Roth IRAs or Roth 401ks. So if some of you have the Roth, and that's why a lot of financial advisors like the Roths, because there is no required minimum distribution. You can keep it in the account and it can continue to grow. Qualified charitable distribution. So this is a really good provision for those of you who cannot itemize your deductions. For 2025, the limit is $105,000, and for 2025, the limit is $108,000. For 2024, it was $105,000. So basically what this means is if you don't need the minimum distribution amounts that you're required to take out, you can direct it to a charity that you believe in and want to support. So when you do that, that minimum distribution then is not taxable to you. You still have to report it, and then the taxable amount would be less whatever you donated to that charity. And that, again, I really want to emphasize this because it's really important, because many of my clients that are older, they don't have any itemized deductions, but they still want to support their charities. So this way they can do it, and instead of them getting their retirement money income and writing a separate check for their distributions, which they won't be able to deduct, now they can just direct their minimum distribution to the charity, and it's not taxable. So they are getting a benefit for that write-off. The most important thing to remember is that if you have done this, you need to let your tax preparer know, because I don't know why they still haven't fixed this, but there's nothing on the 1099-R form that indicates that you made this qualified charitable distribution. It's very frustrating. Okay, Secure Act 2.0 had a lot of changes on this, and I'm not going to necessarily go through all of them, but basically, I'll just hit on some of them. If you fail to take your RMD, and I have had clients that have, they just weren't aware that they had to take their money out and no one told them or reminded them, the penalty decreased from 50% to 25%. Inherited IRAs, so this is another tricky one because that rule kept changing from year to year. So if you have an inherited IRA and the account holder died after 2020 or later, you don't have to, for years from 2020 through 2024, you didn't have to take that minimum distribution. So they put it off to 2025. So right now, you do have to, starting in 2025, you do have to take the minimum distribution if you have an inherited IRA. Individuals can withdraw, it's not much, up to $1,000 per year for emergencies without penalties. Also, with the current declared disaster with the fires, there are some provisions of taking money out from your retirement accounts and not being penalized for it, and being able to pay it back within 3 years, and being able to, if you take the money out this year because of the disaster and pay it back over 3 years, then you won't be taxed on it. 529 plan, so as we mentioned, if you have a 529 plan, or if someone that you designated for a 529 plan has had it for 15 years or more, then the beneficiary can roll up to $35,000 into a Roth IRA. So if you have a grandchild that you opened up a 529 plan for, many years ago, they got scholarships or, other methods of being able to pay their tuition, then they can now take that money and roll it over into a Roth IRA. So it's another savings vehicle for them. This, let's see, I'm sorry. So this talks a little bit more about it. The important thing to remember is that California doesn't conform to it. So again, Brandon will hit on the California rules, but California doesn't conform to a lot of the federal rules. So it really is important to be aware before you make any planning decisions on knowing what your California tax effects will be. Social Security. So Social Security receives a 2.5%, which I'm sure some of you are already aware of, for 2025. In 2024 was 3.2%, 2023 was 8.7%. You earn 4 credits a year, and once you reach 40 credits, you're eligible for Social Security when you reach your retirement age. I want to go over this last point here. This one is kind of near and dear to my heart because my husband's a teacher, and before he was a teacher, he had a job where he did have Social Security withheld. And until this law passed, once he retired, he wouldn't get his full Social Security because he was part of the public retirement system, and his Social Security would be reduced even though he contributed to it. Well, this just passed January 5th, 2025, and affects a lot of government, public workers that receive a pension. If they contributed to the Social Security system and got their 40 credits, they now are able to get their full benefits from Social Security. So that's a huge change. I'm not sure what it's going to do to the Social Security system, but that's effective 2024. So some retirees will be getting their Social Security that they weren't entitled to in the past. Benefits can be taken at any time upon reaching age 62. You're eligible for Medicare at 65. You're eligible for your full primary insurance amount at age 67. And I guess the question always is, how long do you delay it? Do I wait till the maximum when I'm 70 to get the best benefit? So, there's no one right answer for everyone. It's each individual talking about it with their financial advisor or their accountant or, whoever can guide them on looking at their spending habits, life expectancy, and your necessity. This was published recently, and as you can see, and again, I'm not sure what that Social Security Fairness Act is going to do to this, but right now it's expected that the full benefits are expected to last until 2033. So, what that means at that point, we're not sure. People are saying that the recipients' payments are going to be cut to 80%, but again, it's speculation. We don't know what's going to happen. But, we stay on top of making sure that we inform our clients. And that's part of the consideration, whether you're trying to decide whether to delay, taking your Social Security benefits out now or later too. We kind of talked about this, but the retirement age currently is 67 if you were born 1955, and if you're born 1960 or later, it's 67. And if you take it out early, basically you do get a reduction if you continue working until you hit the full retirement age. Medicare premiums, so also Medicare premiums are affected by your income. And this has affected some clients as well. So basically they have, one big event where their adjusted gross income is huge because they sold their house or they had some big transaction and it just hit them for 1 year. And then all of a sudden their Medicare premiums jumped dramatically because again, they base it on your adjusted gross income. Unfortunately, that's just the case, and you just need to make sure that after that triggering event happens, that the Medicare premiums go back down. If you're still working or have earned income, the IRA contribution is $7,000 in 2025. It didn't change. Your spouse can make IRA contributions even if your spouse doesn't have earned income. This is a new law also, 401k catch-up. So if you're between the ages of 66 to 63 and you have a 401k, the catch-up is $11,250. So that's really important. It's just if you're between those ages. So a lot of people aren't aware of this rule, and they just are doing the regular catch-up of $7,000, or I think $7,500. But now they can make a little bit extra. I just reminded actually a couple of friends. It's like, hey, just make sure you check with your employees or your employer because you can now contribute more if you want to. This is something that just came out in November, and to be honest, I haven't checked it out myself, but it's a retirement savings lost and found database. So if you, worked for someone a long time ago and you weren't able to, or you forgot about it, or you don't know how to track them down, this retirement savings lost and found will help you find some of that money. Like I said, I haven't checked it out. I don't know, Brandon, if you have, but it's something that might be worth looking at. Again, just be very careful when you're looking at sites like these that this is the legitimate URL, but make sure that you're using it exactly how it is and not being directed to something else. Backdoor Roth conversion still an option. So for a lot of my higher income individuals, they don't qualify for making a current Roth contribution because their income is too high. So they make what's called a non-deductible IRA contribution, and then a month or two or, several months later, they convert it to a Roth IRA. So what that means is they make the $7,000 contribution to a non-deductible IRA and just keep it in a, low money market or even non-interest-bearing account a month or two, or like I said, whenever they are comfortable with it, we'll convert it then to a Roth. So when you do that, you're only taxed on the earnings. Well, if they kept it in a non-interest-bearing account, there's no tax, and now they have money in their Roth account that they weren't able to do directly. The IRS keeps saying that they're going to get rid of this, but they haven't yet. So it's a great opportunity for a lot of high-income payers. Oh, one more, I'm sorry. One more thing about Roth IRAs. So Roth IRAs, as many of you know, when you take that money out, you're not taxed on it. So if you have some type of event in a current year that causes your income to be lower than your, let's just say your normal years, then you might want to consider converting your retirement accounts to a Roth. So even though you pay taxes on converting those funds into your Roth, if you're in a low income year with a low bracket, it's not as devastating as if you were to do it in a quote normal year when you're in a higher bracket. So I'm trying to think of some instances, but I've had clients do that where, they just had a ton of losses in one particular year. And I'm like, let's see what the tax effect is if you're going to just convert all of your IRAs or a good portion of your IRAs into Roth. And so they did that, but they were still able to be like, let's just say a 22% bracket instead of 37%. So now all of their retirement funds are in the Roth, which they don't have to worry about taking it out at any particular time. Capital gains and qualified dividends, these are taxed at different rates. Again, it's a bracket, it's like a layer, so same thing like the income tax rates. It's based on what your income is. California does not have a capital gains rate. A lot of people still don't know that, so there is no special capital gains rate for California. Capital losses are netted against your capital gains, so if you have capital losses, they reduce your capital gains, and you can take a net $3,000 of losses each year, and the rest carries over. Net investment income tax, so I'm sure, again, this was part of the TCJA, and this was a negative part of the TCJA, that there's an additional 3.8% surtax on your investment income. So this is interest, dividends, royalties, capital gains. It even includes the sale of your home. So if you sell your house at a gain, you'll be taxed on the 3.8% if your income is high enough. So modified adjusted gross income over 250 for married, single of 200,000. So once you're over that amount, you will be taxed on your investment income. So it doesn't include your active income, your what's called your trade or business income, and any tax exempt earnings. It is taxed on your annuities, though. And we do mention this because, like I said, a lot of clients don't know that they sell their homes and they have a substantial gain. They do have to pay the 3.8%. And it's reduced by some deductions, but honestly, it's not much. Investment advisory fees are no longer deductible for federal purposes, so you can't reduce it by that. Investment interest, not many clients have investment interest expense. And state income taxes, as many of you know, your taxes are limited to $10,000. So again, it's not much of deductions that can offset the net investment income. Brandon's my case guy. I can take it. Oh, okay.
Might as well.
Yeah.
So going into the net investment tax, because this kind of takes everyone by surprise a little bit. Because when they sell something for a gain, they think, oh, it's only going to be 15%, but you add on California, you add on this tax here, and suddenly you're paying, 35% if you're in that upper tax bracket on the gains. So, but this court case was Senti versus US, so Supreme Court. So trying to argue that, he had 3 K-1s issued to him, which he had limited activity for, and he tried to prove that he was an active manager of those activities that required over 100 hours each and 500 total for all 3 activities combined. You can aggregate those passive activities together. And if you get above that 500 threshold, they're all active combined as one effort. The problem is he didn't have enough documentation on those, the hours that he submitted. He didn't have timesheets. He didn't have a lot of emails or phone calls or things like that. He referenced another court case where the taxpayer brought in collaborators, people who worked with him, and said, yeah, he was on site every single day for 8 hours a day. He didn't have that. And so the courts denied him that extra benefit of avoiding the net investment income tax. So if you are looking at turning some passive income into active for tax benefit, just make sure you keep your hours, you document, you build a case around it. Simple as that. Foreign reporting, if you have any foreign bank accounts, be sure to report it. It's really easy for FinCEN to find foreign accounts under your name, under your social. I have 2 cousins there. They say it takes them a couple seconds and all these accounts are populated. So there's no reason to hide it. All you do is you claim that you have a signature authority over a bank account outside of this country, and that's it. Same thing where you report foreign income as well. But if you do not comply, if you try to hide bank accounts, there are very, very steep penalties. Bittner, that court case below, he was looking at over almost a $3 million penalty for not disclosing all of his accounts. But the Supreme Court ruled that it's a penalty imposed per return, not per bank account. He had a bunch of bank accounts that he had signature authority over. And I have one client, he was working in Brazil for a hotel chain. So he had signature account over several dozen accounts. They weren't his, but they were under the hotel chain. But since he had signature authority, we had to claim every single one of those accounts on his tax return just to be safe. And this is kind of another example, but similar to what I gave you. For credits, so tax credits, there are a bunch of them that changed with TCJA as well, and I'm sure they'll change next year. But we have child tax credits up to $2,000, and all these credits are often limited by income. So if you're a high income earner, a lot of these don't apply. But the first 3 are related to child and dependent care. You have the adoption credit, which won't come close to covering adoption fees for $17,000. It's quite expensive. You have, out of this one, you also have some educational credits, but again, they're related to your income, earned income tax credit, which is a pretty high audit area for claiming that. And it's because it's focused purely on low-income workers. And so people, you'll see a lot of articles if you Google it about earned income tax credit audits. A lot of people get caught trying to claim this credit because it is a nice credit, but you really have to be in the lower income region. And then foreign tax credits for taxes you paid overseas. And the foreign tax credit actually, you'll see that on your 1099s with your brokerage statements. You'll often see foreign taxes paid if you have some funds that have foreign activities in them. Inflation Reduction Act. This is for until 2032, maxed at 10 years because of the Byrd Act, which I'll go into a little bit here. But it's the largest effort to promote reductions in greenhouse emissions. And so there are several aspects of it that are really cranking into this year. I know the Trump administration is gonna try to attack this, at least they said they would. So, you know, like I'm installing electrical vehicle charging stations at my commercial properties, and I told all my contractors last year, I'm like, this better go live by December 31st, just in case. So, you know, we had a lot of acceleration on solar and electrical vehicle charging stations and things like that out of this act, just in case something happened this year or next year. I was being a little cautious. But clean vehicle credit up to $7,500. It applies to all the manufacturers with final assembly here in North America. Retail price is limited to vehicle, is limited per year, and you have to keep your car at least 30 days. So you can't be doing this every single month, taking $7,500 and transferring car after car after car. It does apply to leased vehicles as well, which typically for leased vehicles, the dealership will just take care of it within the closing statement. And it can apply to used vehicles as well, though you're capped and you have to be the second owner. So the leased and the used option is kind of a nice change with this aspect because you're taking advantage of the commercial side of it, not the personal side. So there are a lot of credits out there that you can use. You can even get a credit up to $1,000 for your recharging station if you put like a charging station in your garage. You can get a credit for that. You can get credits for home improvements that improve energy, and it could be everything from windows, doors, insulation, water heater, HVAC, what else? AC, of course, solar. There are quite a few things that qualify for up to $1,200 annual now. This used to be very small in previous years, and it cranked up just this year in 2025, and it'll stay at that $1,200 annual. And then we have clean energy, which is related to solar, fuel cells. We probably don't have many heat pumps here, but you get 30% on that cost. For standard versus itemized deduction, so I believe it's around $28,000-$29,000 for married filing joint, the difference between standard and itemized. And this has changed since the TCJ Act of 2017. But typically when we see someone switching from standard to itemized, it's related to a mortgage is the one thing that kicks them above, or heavy charitable donations tend to be the two that kick you over. If you're already paid off your mortgage, typically we always see standard, in which case Carol mentioned the gambling losses won't apply in that scenario unless their winnings are pretty substantial. They bring you over the amount. So you always got to look at, if you are standard, look at another way for charitable contributions or gambling losses or things like that to try to get it into the deduction category. California does not comply. We still have miscellaneous deductions subject to 2%, which are like, you got like tax preparer fees for one of them, safety deposit boxes, investment expenses for your advisors, and some other things that can be deducted. And the key is if you split your return, which we split a lot of returns when they're over $1 million here in California because you can avoid a mental health tax of 1%, at least until you make about $2 million, then it kicks in again. But you can't take itemized on one spouse and standard deduction on the other. It has to be consistent. And unfortunately, I've seen a lot of tax preparers make a mistake on this one when we get new clients coming in. Medical expense deduction. So if this deduction only kicks in when it's above 7.5% of your AGI, then it becomes deductible. So you can't take any deductions related to cosmetic, and you can't really take things like gym memberships or non-prescription medications or things just at CVS you buy on the shelf. Pools, air conditioning without a doctor's note, it's very difficult. With a doctor's note, then you get in some gray area of like, okay, can we take this or not? There are a lot of cases behind it. I put a link there about some questions asked to the IRS, but there is some precedent to taking them. There is also court cases against taking them and trying to abuse the system. But for medical expense deduction, we typically don't see this kick in unless they have, you have retirement communities, live-in nursing. Those are the high costs that really put this into a deduction category. Or you have a really low income year where this will apply. Some of the things related to mortgages is the SALT limitation, which has been in effect since 2017. Property taxes and state income taxes on the federal level limited to 10,000. California is different. We're still under the old rules. And the mortgage is limited to the interest on up to $750,000 if you bought your house after 2017. But if you bought it before 2017 or 12/31/2017, that limit is $1 million on your mortgage principal. And California is still up at 1.1, hasn't changed for several years. And it applies to both primary and secondary homes. The Voss case is an interesting case. We brought it up last year too. If you're thinking about getting married and you are co-owners of a house, your limit is capped at 2.2 million, not at 1.1 million. Once you get married, that cap goes down to 1.1 million because you're now a single unit. You're not two units. And the court cases, the Vosses went to the commissioner and clarified this, and the courts basically said, yeah, we realize this is a marriage penalty, but that's the way the law states. So it's a little surprise to high income earners who jointly own a home and they're about to get married. I have this come up a couple times a year where someone's asking me, should I get married before the end of the year? And it's like, well, you're going to lose out on like $30,000 of deductions by doing that. And then they kind of think twice about getting married again. But I also caution all my clients, don't take my advice to not get married just because of a tax deduction. So the IRA charity, I think we hit this pretty hard. I'm going to kind of, well, I'll go quickly over it. We do have the Secure Act 2.0 allows a qualified charitable distribution up to $50,000 to a gift annuity. This is kind of a unique part of the code. I actually did this with one client last year, and you get an annuity where you get income back and you get the charitable deduction for it. This allows your QCD to go through your IRA, but you can always do it outside of the IRA as well. And for charitable contributions, these are some of the limits that are applied to the deduction, and it's carried forward over 5 years if you don't use it all. And the key part is documenting. Always document your charitable contributions. We can't harp enough about this one because this tends to come up in an audit every single year for our practice where there's a substantial charitable contribution, and the auditors will focus on those amounts because they see a lot of abuse in that area. So if, just as a take-home advice, if you give over $250, document, get a letter. Letter is key from the charity, and that letter states in bold under at the bottom that no goods and services were exchanged for this donation, and this is the value of your donation. We include a chart here of what you should do if you're giving certain thresholds, and if you're giving over $5,000, then of any objects like art, vehicle. We had a client give an apartment building one year. You have to get those qualified appraisals, and you have to follow the form, the IRS form and guidance to the T. or the IRS will try to disallow it. Even if you have all the documentation, they will try to disallow it on a technicality. We've seen it many times, unfortunately. Here are some court cases. Lucio, this was a pretty thick court case. He was a CPA. He wasn't a very honorable CPA. So the courts went after him, and they went after every single aspect of his tax return and just hammered him. But just focusing on the donation part, he had a $500 donation, which he actually did. And as his proof, he provided the credit card receipt and a document from the charity, which is a 501c3 charity, showing him as a $500 membership level donor. And the court's like, well, you don't have a letter. You have a website that shows your name, but that's it. So we're sorry. And they didn't allow it. Carter, this is one about a conservation easement. I only bring this up because conservation easements are one area where organizers will try to take advantage of taxpayers, saying, you invest $50,000 with us, we'll give you a $150,000 deduction in year one. So when that happens, your alarm bells need to go off. It doesn't make sense. So conservation easements are basically, I'm going to buy land, I'm going to value it at a much higher price because that's the fair market value if I develop it, and then I'm going to give it back to the US and create a conservation easement where it can't be developed for, eternity, essentially. So here, Carter was saying that there are only two members of this partnership. The 500-acre conservation easement they donated had a value of $14 million per an appraiser. The IRS came back and said, nope, we're sorry. They originally said it was worth $0. Then they came back and said, okay, we looked at it. We had an appraiser look at it. It's only worth about $1 million. And there are some statutes on this one where the courts are not going to audit, I believe, up to 8 times or so the value accelerated from your purchase, depending on the scenarios. But this has been a pretty hot area of audits over the past few years because there is a lot of abuse. And there's even some on President Trump, if you want to Google that one. Annual list of tax scams per the IRS. This is an annual list, and it's typically the same actors. You get identity theft, which you can get a 6-digit PIN from the IRS if you want to protect your identity, at least on the tax filing. You have avoidance strategies. This is one where I'm talking about the conservation easement, where promoters are trying to sell you something that's too good to be true. Unfortunately, it is. Improper donations. You have tax advice on social media. I get this about every other week where someone sends me like a Instagram or a TikTok or something like, hey, this person is telling me to take this deduction through my business. And unfortunately, it's only like 30 seconds long, and they forget to include all the other facts that need to substantiate such a deduction and why it doesn't apply. So just be very careful. Carol mentioned also artificial intelligence like ChatGPT and AI, Claude and all those other programs. So we've been kind of testing these programs and putting in tax case scenarios of like, how would you treat this scenario? I remember doing it last year, and I was talking with the AI, and I said, how would you treat this? And it gave me the wrong advice, and I knew it. And I replied back to the AI, I'm like, well, I think it's actually this under this scenario. And the AI replied back, it's like, oh, well, thank you for that advice. We'll take it under consideration and try to modify our responses in the future. So it's learning. It's not quite there yet, though. Right now, we use it as a tool, a helpful tool for conversations, for emails, things like that. But when we're using it for doctrine, not yet. It's not close yet. You also have on this, found this fun, you had scammers and then helpful scammers. I didn't really know what the difference was, but that was 2 months of scammers. And then you had the employee retention credits and EIRCs as well, which I mentioned previously. But overall, just be careful. That's all. That's the premise. And, you know, if it sounds too good to be true, or if it's threatening, something like that, if something must be done today within hours, or your bank accounts are going to be drained. I got that call last month, and I spent 45 minutes with that scammer just to have fun and learn his strategies. You know, don't stress. Find the actual number of the company that's calling you, call them directly, and find out what's going on. Virtual currency, this is going to come more and more every single year, but if you own some, or if you own some through a fund, which you may or may not know you do, you just have to check a box on the 1040 saying that you are an owner. If you sell it, you have to report it, and they're getting better at reporting, but this has been kind of the Wild West of the past few years, so the requirements are coming down pretty hard on 2026, but not quite yet for this year. And also Bitcoin holders. Bitcoin it's huge. US and China are in the top 10 holders. In the US, a lot of that's confiscated. So we have some very big players in this market, and it's not going to go away. So Carol and I have been mentioning the Tax Cut and Jobs Act is sunsetting December 31st. That's because it was passed in 2017, and because of the Byrd Act, you cannot put in legislation that increases the budget deficit beyond 10 years. That's why this has only been in for 9 years. And so now we're just these are the big ticket items from the Tax Cut and Jobs Act that came out. Will they be extended another 9 to 10 years? Will they be adjusted? Will they just go away and we go back to the old tax code? We have no clue. But we have audience participation to figure it out. This is where you guys get to have some fun and wake up a little bit, because I know this is really exciting to hear us talk. So I just kind of want to see a share of hands here. Individual income tax cuts. So there were $4 trillion in tax cuts with this tax code that are going to come back up in 2026. So will the Tax Cut and Jobs Acts, all those provisions that we've been dealing with over the past 9 years, will they be made permanent, which takes 60 votes from the Senate, so a supermajority. So they couldn't get a supermajority in 2017. All Republicans voted for it, 0 Democrats. But a show of hands, who believes that they're going to be made permanent with 60 votes? 3, 4, 5, 6. All righty. And who says no way? A little bit more. And who says they just extend it? God, it's like even across the board.
We'll report back next year.
All right, well, maybe this will be a little bit easier. We heard J.D. Vance and President Trump say a lot about expanding the child tax credit to $5,000. It's currently $2,000. So it's kind of a low-hanging fruit one. Who thinks this will happen? Oh, man, you guys are hesitant on that. Yes, I didn't say no. And yeah, I'm going to go 60-40 on the no's, taking precedent. You heard about this with Nevada. Both Democrats and Republicans are saying we're going to eliminate tipped wages. What they didn't tell you is tipped wages don't get reported anyway. No one reports their tips. So who says they're going to just eliminate tipped wages? Oh, just one. Okay, how about no? Okay, no's have it. Oh, all right. Clean energy tax credits. That was that 2022 law for $7,500 for Tesla vehicles and, you know, home energy improvements and everything else. Who says that's going to be eliminated? Yes? 1, 2, 3, 4. And no. No's have it. Yeah. Here are some other tax proposals. The SALT deduction has been talked about as well, bringing that up from 10,000. Although there's a workaround for pass-through entities in a lot of the states where it's high property taxes, more made in America, and some auto loan interest deductions. So these are some ideas. We're going to find out what happens over the next 12 months because something has to happen before December 31st. This are items that will increase our budget, only about $11.2 trillion. Yeah, small amounts. But yeah, you can see in your slides, but these are just basically the costs of each proposal, and we'll find out what actually happens over the next, by the end of the year. These are items that will actually reduce the deficit. But, I've learned that if you reduce it here, it goes up here. So, yeah. But we'll see. It'll be exciting times for tax professionals. California, as Carol mentioned, we don't comply with anything. One-time penalty abatement, this happened in '22. I got to use it once last year for the first time. I don't know if you've used it. It's basically a one-time, once-in-a-lifetime use of a whoopsie, where, I forgot to pay this quarter or this year, or, made a mistake that led to a huge penalty. You're allowed to take a pass on it, which is great. Federal, it's a little more lenient. You could do this about once every 3 years, I think, as on average. Cal Savers is requiring retirement accounts for all employers with 1 employee or more starting at the end of this year. It's currently 5 or more employees where it's required. And you can go through Cal Savers, which is essentially free. You can get a 401k plan established, simple IRA, things like that. Pass-through entity tax, I mentioned this briefly, but this helps get around that SALT limitation of $10,000. And it allows small business owners who have a pass-through entity like an LLC or an S-Corp to take advantage of an extra deduction on their federal return by prepaying state tax. And the probate court small estate exemption, this is just a little thing on probate values because probate costs are very expensive unless you have a living trust that can get you around doing probate. But the exemption is raised as of 2025 on the gross value of your residence. Retirement outside of California. If you decide you had enough of California tax and you want to go to Nevada or Texas and spend your retirement years, or Florida, which is a popular destination, and you're taking retirement and pension that you technically earned here in California, California can't tax that. It also applies to deferred compensation plans. That's like Shohei Ohtani's one big example everyone knows, but there are a lot of programs, especially at a lot of hospitals here, where you can defer income for high income earners and recognize that when you retire or 20 years down the road or what have you. And if you move out of state, that's taxed at that state. Remote workers, this obviously big since COVID. W-2 employees working outside of California are not subject to California income tax, but 1099 contractors are. And every state has a little different scenario here. So if you decide to work remotely, you have to look at sourcing your income. Community property state, we're in a community property state here in California. Everything is split 50-50 unless you have a pre or post-nut agreement. And so that, that's related to marriage. Always a fun thing doing split returns for a couple. And they are always problematic when you split a return and you're trying to split a W-2 in half. And the IRS has one W-2 and they have half for each. And their computer system just goes AWOL at that point. So whenever we do this, we just warn the taxpayers that, like, hey, you're going to get a letter, give it to us, we'll take care of it. Not a problem. These are some of the property items. Proposition 19 is going to come in big over with the wildfires because you have up to 2 years to transfer your basis to another residence if you're subject to fires, wildfires, you're destroyed due to, unforeseen circumstances. So you're going to see a lot of things happen or a lot of news about Proposition 19 over the next 2 years. And Proposition 19 again, allowing you to victim of wildfire again, transfer the property tax basis. And always be careful about appealing your valuation if you feel you're paying too much property tax here in California. This is an example that went the wrong way for the taxpayer. And they said they had a huge shopping center. The assessed value was $94 million. The taxpayer argued it was only $48 million after retail prices went downhill. You think about office buildings, how those are just being sold for pennies on the dollar. And the assessor said, nope, it's actually worth $113. I made a mistake. It should have been higher. Is it a Q? I can't pronounce that last name. I'm sorry. This is another one. This is always fun on selling a house that you've had for 40 plus years. I had an older taxpayer. She was in her home, since the 60s, and she sold it last year. And it was awesome. Came in with a book that thick of every single repair receipt of the house since 1960. And that took me a few days to go through, but I put in every single receipt. And increased her basis and decreased her capital gain. But to have that record keeping is awesome. I was amazingly impressed. And records, if you are going to go for that, records are obviously critical. This is one court case where he had some of the records, but they weren't complete. He was just submitting receipts, which didn't actually show what they were for. And it wasn't related to completion dates. They didn't have actual dates on the receipts. So I didn't have all the details on this case, but it goes to show that if you're gonna document a deduction or a basis adjustment, you have to have a pretty thick proof behind it. And ultimately what California did was they used a cost estimation software to try to get to the best amount that they should have spent for construction costs. And this is the same thing that auditors will do for a cost segregation study if you ever get into that. Rentals. This is a fun one. We've all heard of Ed McMahon. He was game show host back in the day. He was going in default. An investor bought his home and rented it back to Ed for $0. So he was the winner of that game show. Unfortunately, he tried to also deduct it as a business expense, all the rental costs like the property tax, mortgage interest, all that. And the courts did not agree because he wasn't in a profit motive business. That makes sense. He tried to argue that he was just keeping the house for appreciation purposes, which actually does have tax court precedent. He just didn't have the facts and circumstances to support it there. So, or he just maybe didn't have the best lawyer. So there you go. But Ed McMahon, he got off with free rent though, which is nice. Individual return filing requirements. If you make over $400 self-employment income, you have to file, or if you're over the standard deduction limit for your bracket, you have to file. Nanny, if you have a nurse, nanny, gardener, anyone you pay cash over $2,700, you have to file them as a household employee. And I'm sure about 10% of you do that or so on average. It's okay. Individual income tax return must be filed. This is for dependents, kids who have unearned income. Think brokerage statements that were given to them by grandparents or their parents gave them money and they make either unearned income through their brokerage or if they actually earn income through like a summer job or things like that. All right, tax returns. I think the IRS started accepting them. we can't file them until starting the 15th of January. The IRS is shut down. But you do have free file options if your income is 79,000 or less. And as of last night, we are postponed until October 15th, at least per the IRS. The Franchise Tax Board in California has not matched that yet, but they almost certainly will, Monday or Tuesday. That means all your quarterly estimated payments from January up through September are all deferred until October, including tax filings, payroll, whole thing. So it's all deferred. So you have to look at the news, and related to IRS and FTB, they'll give you guidance, but this includes all of Los Angeles County right now, as well as anyone who has their tax preparer or business is based, their paperwork here in Los Angeles County. So this is something that we extend to our clients, and like I did it for clients in Maine and Colorado and things like that, since we keep all the financial records and we do their tax returns. It also applies to people coming here to fight the fires out of state and are working with a government or a nonprofit. It also extends to them as well, which is kind of awesome part of the law. This will also, since we are now a major disaster area for Los Angeles County, then some other deductions come into play again as itemized deductions for repairs and everything else. So, but yeah, if something happened to your home, obviously there are more things to worry about, but taxes are not one of them for right now. And we have some questionnaires that we tend to send to all clients in the back there that help you prep. And yeah, we just try to summarize the individual tax code in an hour. So we left a lot out. It's intense, but we did our best. Questions? Oh, if you have any questions, just pass them to Nicholas or just hold them up. And we'll try to answer them. Take them all.
Let's do that one. Real quick, I know that, especially in the back, it's been very difficult to see some of the slides because of resolution of the screen. I will email out the presentation as well to everyone that is here or not here as well if you need any additional copies of it. Those that did not get it, please let me know and I will mail it to you or email it to you as well.
Want to go?
Here you go.
Okay. The charts don't address married filing separate. Yeah, there we go. I thought it did, actually. I'm sorry. Oh, maybe they, oh. Yeah, single head of household. It's basically half of the married filing joint for married filing separate. And disadvantages of going married filing separate versus married filing joint. Again, it depends on how much income you make. There are advantages to splitting, at least from what we see when you make over 1 million. Below that, it tends to be a disadvantage for married filing for splitting the return. from a tax perspective. And there are also some things that you lose out on, like a student loan deduction and some other items that don't come in as a deduction there. You want to try that, or?
There is a question, sorry. If you make a QCD from your IRA, I was told the charity has to cash the check by 12/31 of the year received, or the donations is null and void. I have recently been told that as long as the charity is in possession of the check, they have a year to cash it beyond the 12/31 date, which is correct. I believe as long as the charity receives that donation, and obviously issues the acknowledgement letter, the donor acknowledgement letter, that it should be okay, and it should still qualify for the qualified charitable distribution.
That's correct. Once we get it.
This one's easy. If you're on the board of directors of a 501c3 and have a signatory right for, I'm assuming you mean for a foreign account, do you have to declare that account on your tax return? You would still have to, yes, you still would have to file the form for the foreign reporting. Oh, domestic? No.
How does anyone know how much you give to a child or grandchild? I'm basically meaning how do you get caught is basically it. It's an honor system. It really is. I've never seen an audit, have you, where the IRS tracked the payments? That'd have to be pretty bad where you did something else to get into the jail and then they would tear through everything. I guess Giuliani would be one case where he's went bankrupt and he's facing big fines and payments. They're going through all of his files right now and saying, you know, his World Series rings, he didn't actually gift that to his son and they're taking them back. That would be one scenario where if you break the law enough, they will find a way. So, but otherwise, $20,000, that's going to be hard.
Did you say regular IRAs can be converted to Roth IRAs with any income? Regular IRAs can be converted to Roth. You just have to look at the tax consequences for doing that.
Medical care, doctor has you in a retirement housing. Is this tax deductible? Depends on the type of housing it is. If there's medical portion of that housing, nursing care, things like that, then yes, it is deductible and it's above that 7.5% AGI. He's done?
Yeah.
Okay.
When documenting repairs and upgrades to a home, what info is required? Kind of as Brandon mentioned with that one case, you want to document as much as possible, the date, the receipt, the payment, a description of what, the invoice, which shows a detailed description of what was done to the home. So, basically keep one file for your home and any improvements that were done with the payments and the invoices, just keep in that file. Sorry, just this real quick. Someone mentioned about the Social Security Fairness Act that I mentioned. When will the people get their benefit, and will they go back for 2024 and more years? They're only going to go back for 2024. I'm not sure, to be honest, on the actual process of how it's done, and I would imagine it's going to be a lump sum as opposed to a monthly payment for the back year for 2024.
This is for standard deduction for someone in their 70s. We have additional deductions depending on which bracket you're in for additional deduction of $19.50 in 2024 and $2,000 for blind or elderly. If you're both blind and elderly, you get both deductions, and the standard deduction limits are just above that.
If teachers can get full Social Security now, will the state teachers' retirement be reduced? I don't think so. That's not my understanding. I hope not, for my husband's sake.
Can you reinvest RMDs into a Roth? I don't think you can unless you have active income and put that in, but I don't think you can.
For the elderly, if your income is below the filing limit, no large investments to declare, is there any reason for filing a return? If you're not required to file, there is no reason to file. They asked, should you file anyway to help with those settling an estate in the future? You know, as we talked about throughout this presentation, keeping good records is the most important thing. So, you know, it applies to everything, not just your taxes. So if you're worried about your estate, you know, just keeping good records and having that available to people and knowing, and them knowing, your beneficiaries or your trustee or your advisor knowing where those records are, that's the most important thing.
This is on the recovery rebate credit. If you didn't get the check and you thought you were supposed to get the check, credit, gift card, how do you get it now? And there's a place on the tax return where you list the recovery rebate, how much you received and how much you did not receive. And if you meet the income categories for it, then it'll be given to you on the tax return itself.
May I file a 2024 joint return if my spouse died in 2023? No, so 2023 would be the last year that you file as married filing joint.
Not sure about that one. Do you want to split? LA County tax clients living out of state and out of the US are also able to take advantage of the extended deadline to October. If they're LA County residents, well, they're not residents anymore. If they're tax preparers here, yes, that's for sure. It also depends on which state they're actually filing under as well. So the tax extension, if it tracks exactly like it did over the past couple of years, it'll just apply to California and federal, but if you have other state filings, it won't apply to those alternate states. You don't have extension in the other states. So it just depends on this specific client's scenario of which state they're claiming and who they're using to do their tax return and what their previous address shows on their tax return. But we can always, tax preparers can add people to the bulk exemption. They could process your name and social security number for you just to make sure you're on the list and you don't get a penalty.
Can you pull the annual tax-free gift amount from a traditional IRA, thus avoiding taxation on the $19,000? No, you can't. And just remember, there's no tax on the gift of $19,000. It's just a reporting requirement. And the second question was, do you need to pay taxes to the U.S. for foreign bank accounts which houses an inheritance in excess of $10,000? I'm not sure I understand the question on that one, so you can see us after.
Remote work, how do you prove that you're working in another state or out of the country? Yeah, it's an honor code, really. But if you do get audited or if you do commit a crime, they're gonna look at like cell phone records, lease agreements, your credit cards, things like that. This is what California also does to confirm, if someone tries to escape the state to avoid a big cap gain or something like that here, they'll take them to court and try to prove that they were actually here the majority of the time. Not sure on that one, I'm sorry. I guess computation of the RMD, I'm trying to, it's asking, does a custodian compute it or is the holder responsible? So I always see the custodian making the calculation. We also do the calculation as well for our clients if they ask us to. It's not a difficult calculation to make. And so there is a publication for the IRS that tells you exactly what to do, but either your custodian will do it automatically for you and you tend to get a letter at the beginning of the year. Yeah, beginning of the year for the RMD that you're supposed to take on the accounts, or you ask your accountant to do so. What we often do as well, if a client has multiple retirement accounts, we may just take the RMD from one account instead of taking like 5 or 10,000 from multiple. And then that way you do the calculation across all accounts and just make it easy on the brokers to just focus on one. I think that was it. All right, thank you. We'll be here for a bit.
Fantastic job. First, I want to again say thank you to Brandon Hohm and Carol Kulencavich for your presentation and all your expertise. Thank you very much. Appreciate it. Now, I left my box for the exciting part. Give me 1 second. Be right back. All righty. The reason that everyone actually really came was for the free gift certificates, right? All right. So I have 5 gift certificates for $15 each. The first one we will do will be for a Starbucks gift card. Carol, can you please do the honors? All right. 126359. 126359. There it is. Congratulations. All right, next one. McDonald's, $15 to good old Mickey D's. All right. Ooh, sorry, that person just got an extra chance. Here we go. 126297. Did I hear bingo? There we go. In and out, $15. In and out's still cheap. That's like 2 meals still. Oh, okay. Shake it up, shake it up. Switch. 126264. There we go. Congratulations. All right, the next one's for Five Guys. Five Guys is expensive, so this is like half a burger. Sorry. I should have thought through that a little bit better. One, 2, 6, 3, 6, 0. Yeah? In the back of the room, walking in?
She tried to get out.
Yeah, she tried to leave and heard her number. Fantastic. And the last one more Starbucks gift card because everyone loves coffee. Give you the wrong thing. Tom? Thank you. 126306. 126306. All right, don't leave yet, don't leave yet. I know everyone's excited. I wanted to personally thank you. Again, my name is Nicholas Maddox, AKA the New Sandy. Okay, that will be my name probably for the next year. But I would love to hopefully be able to get to know each and every one of you, hopefully meet with you. Maybe we can go out and use someone's Starbucks gift card and go grab a cup of coffee. So I would love that. Thank you for your attendance. If you're interested in attending the next one, which will be on estate planning, more along the lines of what I do, estate planning and gift planning and conservatorships, you can please sign up in the back. There are 2 sign-up sheets on the left-hand side as you're walking out. If you have any questions or any concerns, there's also, well, if you have any questions or concerns, you can always please get in contact with me. There's also an evaluation sheet on the back. We would love your feedback on anything that you liked, did not like, would like to change, like to see differently. I am very open, as you guys know, as Nicholas Maddox, the new Sandy. This is my first one. So I would love to hear everyone's feedback and hopefully make this bigger and better each and every single time you guys come. That is it. Thank you to the PAC members that are here helping out, and thank you to everyone, and thank you again to our presenters. Enjoy the rest of your Saturday. Have a good day.